I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. So Sarah, we got Patrick on the line. What do you want to ask him?
What obstacles or oppositions did you face when acquiring your first deal, and how did you overcome them?
Quite honestly, there's a huge dropout rate in the space from people that kind of say, "Hey, I'm going to go do it," to people that actually make it happen. It's a combination of oftentimes a career change and being an entrepreneur, and it really takes these two kind of things because. In the space, when I got into it, I didn't know anybody that was in multifamily, and I wasn't certain that the first multifamily was it. I just knew single family wasn't it. So part of what I did was I partnered up. I started talking to people like Brian. In fact, his team, we actually got real close to working on a deal together. But you got to kind of find that path.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe, and I'm very excited for this show today. It's another one of our Ask the Experts on. We got two people on the line with us that I think are absolutely amazing. We got Patrick Grimes and Sarah Hanna. And Patrick, you're up to bat first, so welcome to the show.
Thanks, Brian. Excited to be here. I know that back before we had any deals, or I had any deals, I met you on Slack channels. We were grinding away, doing underwriting. We met at a conference, and it's a couple of years down the line now, and we've both come a long ways, and I appreciate you having me on.
Yeah, it's fun to see, like you said, we started out, brand new together right around the same time, and it's fun to see how we've both gotten a certain amount of success, in completely different directions as well. But happy to talk with you and glad we've reconnected after, quite a bit of time. So thanks for coming on the show again.
Absolutely. And nice to meet you, Sarah. I'm excited
to
hear your story and get some great questions from you at the end.
All right.
It should be fun.
And, I should say welcome Sarah too, but I usually save that to the middle, but Sarah, welcome.
Thank you for having me.
Absolutely. This is going to be a good time here. So, but Patrick, you're in the hot seat first. So let's talk about you for a bit. Talk about your background and history and what got you into apartment investing.
Sure. Well, I started out as a mechanical engineering student and started at machine design, automation, and robotics. For a couple of years of that, I had done a summit at a winery. I'd done a stint at a Toyota facility and then started an automation company. And that owner said, "Hey, look, you need to put all your money in real estate. While this engineering business is cognitively rewarding and a lot of fun, it's not going to provide you the life you want in your future. It's highly volatile and you need to invest as much as you can and as soon as you can." So I took that to heart, saved up everything, dumped it into a bunch of what I thought were very profitable investments in land, and that were going with developers that had a good track record that we're going to build on. And all of that went south because it was back in 2007 when the market was never going to go down. And then so 8, 9, 10 happened. I was able to avoid BK, but it was very humbling. I learned a lot about the difference between speculating and investing during that time. And then when I came out of it, I went into kind of dove back into my high tech career, did a couple master's degrees. And at that point, I realized, hey, look, I'm getting bonuses. I need to get back into real estate. And so then I sought lesser risky assets and better markets, recession resilient job makeups, and in areas that and specific investments where I know I could see a comparable that was already built, already there. And I was doing a measurable lift to that. And essentially the Burr method. But I was a hold investor at the time.
I think a lot of people, kind of got burned around that recession time. And so if I'm hearing you right, you went towards a more reliable, more safe way of investing. The development is a little bit speculative. I mean, you're making guesses on what's going to happen 3 years from now. What the apartment landscape is going to be like. Whereas with buying existing multifamily, I mean the risk is a lot different because you typically have years and years and years of rent history, and you can kind of project that into the future. So. So you did Burr method, or are we talking small multifamily at this point, or were you getting into like the larger stuff at this?
Yeah, well, what you're saying is right on. With the short-term bridge debt and hard money necessary to do the development deals, you can be left without a seat when the music stops, and that's what happened to me. So with smaller single family, what I could do with all of my own money, I felt was a little lower risk, and because I had comparables like you're saying that were income producing, I could buy income producing assets immediately. I started buying, renovating, and holding. But after a while, that got to be single family assets in the recession resilient market. So out of California.
Yep.
After a while, that got to be very tiring. I was moonlighting it. I needed to figure out a way to trade up and not sacrifice my family, friends, and hobbies outside of my engineering job for my real estate investment career. And that's when I discovered multifamily investing, where you can be passive or active, but even on the active side, you can rely on partners to do some of the heavy lifting with you and take on, jobs that you like. And so that's about the time that I met. And when I met my wife, I said, look, I can't continue to burn the midnight candle all the time. I've got to find a way to scale. I can't just do one house at a time. I need to do larger units. And so that's why I shifted into multifamily.
All right. And do you assume your wife was supportive with that?
Well, actually, I think you might have met her at one of the events that I took her.
Yes.
Yeah. Yeah. And she's enchanting. She's amazing. She's in animation production. And we had met when she was going to Cal Arts at the time, getting her master's degree. So she's going gangbusters in that career, but I needed her on board. So I did bring her to various events. It did take some time to kind of educate that, because we had gotten married in California and Beijing, where she's from, to kind of educate on what is this financial investment, entrepreneurship, financial freedom, all this stuff. Were relatively newer concepts. Yep. So it took a little time, but when she got on board, she put her vision board together and she was 100% in, and she was pushing me, and she's a math whiz. So she helped out.
Nice.
Not only in creating 60 passive, or I think she's up to 80 educational videos for our investor base, but she also would help with the underwriting and a great sounding board for the business, while being a production manager, producing feature-length animations. So very happy to have her.
So she's completely in. I mean, she's all in with you, which is nice. For my wife, I talked about the apartment investing, and she was always kind of lukewarm on what my moonlight, my burning the candle job was, my side hustle. But when we sold our first investment property and walked away with a big chunk of money, I remember she just looked at me one day and said, "So real estate, huh?" And ever since that, she's been all in. But end of the day, it's always important that your partner is supportive, at minimum supportive. But sounds like you've got her very much involved, so which is awesome. So one thing I'd like to ask everybody about is their big burning why, their motivation for what they do. So what would you say your big burning why is?
Well, let me parlay, because there was a minute there where I was just dumping energy and time and resources into the business, and she wasn't seeing much back. But we just had our first exit, to your point. Last year, we bought at 27 million and sold at 37 million, March to December last year, 208 units in Florida. And that huge win meant a large piece of income coming back. And that was another light bulb I think that came off, is it's not just on paper now. It's very real, tangible. And so that definitely helped an additional accelerator on the journey.
Absolutely.
But the burning why, I'm passionate about helping people, and I'm a community builder. And I've always been that way. Even my birthday for 12 years, before COVID, I took 40 people up to the wine country on a charter bus for 4 days. And
Mhm.
I just loved bringing people together and doing things together. So the single family journey was very lonely because it was
Mhm.
just me. And it was a lot of work. But with multifamily, I get to not only bring great partners like yourself, Brian, and
Right.
other excellent, very intelligent people out there, and we get to work together to take down an asset where we all bring our superpowers and we do what hopefully you're like doing. Because if you're
Yeah.
not doing your job, you better be passionate about whatever it is you're doing in your other time. And at the same time, we're producing not just something for ourselves, but we're making the world a better place. We're
Yeah.
providing a cleaner, safer, and improved living experience for our tenants because we're buying these properties that have been neglected and mismanaged.
Mhm.
And we are, through the process, investing into the communities and the buildings and producing a better return for our investors.
Mhm.
And not only is that return a good return, but it's all the tax shielding and inflation hedging and recession resilient type of investments that are completely different from what took me down in the first recession, right?
Mhm.
Doing the single family hard money loans, signing as a guarantor, cross collateralizing resulted in me losing everything. And for the single family investor, whether they know it or not, that's oftentimes what they're doing, the
Yep.
flippers and the renters. And on these multifamily, we're all of our investments are on islands and they're
Mhm.
protected. And I think that burning why is each time I do a deal, not only does it take years off of our working life and provide a better life for our family, but it also does so for our investors. And we get to live in this great community and work with great people.
Yeah, I think this is one of the ultimate win-win situations, and probably tack on a couple extra wins on there. So we're helping ourselves. Obviously, we're helping the people we partner with. We're helping the people who invest with us, and we're helping the people who live in the communities. So I've always been a Stephen Covey fan, and one of his 7 habits is think win-win. But I really think this business is a win-win-win-win scenario where there's a lot of wins that come from this. So and one thing that you mentioned, from your experience, it's also a fairly resilient investment opportunity. There can be you can lose your money, but you're a lot less likely to lose your money on existing multifamily than what you said the alternative was. Lots of single family or developments. So well, that said, let's talk about one of the projects you've been involved in. Tell us about your first or your favorite, or whichever, your most recent, whichever one you most want to talk about.
Well, by the way, to your point, is that mindset of the win-win. It's not shared out there by all the investors. And in fact, when we got this property that we just closed on in Houston, we printed out almost a ream thick stack of unanswered maintenance requests. This guy had neglected the tenants, and through COVID, they stopped paying him. Had a 19% bad debt, and which meant uncollected rents.
Yeah.
And he lost his building. And there was all this deferred maintenance. And so we get to get in there. We get to make the lives better of the tenants, give a great return for our investors, and build up the community and make it safer. And so I think it's a great place to be. So you got the whole feel good, but yeah. So our company is doing some great things. We've really got some momentum. By the end of April, we'll have about 3,000 units across Texas, the Midwest, and the Southeast, Eastern states, places like Houston and Dallas and Atlanta, Cincinnati, Ohio, various cities in Florida and northern and southern Carolinas. And those are all value-add multifamily B and C class.
Yep.
We're doing a bit more portfolio type investing now. Right now, we're working on finishing up the raise. It's a $32 million raise for 772 units. Got it at a 7 cap, which means an extraordinary discount. Individual held it for 5 to 15 years and didn't renovate it. And now instead of needing to infuse capital, he's just saying, hey, look, I'd rather get it off my plate, off market to somebody who will take it. And so it's incredible opportunity. And I'm real excited because it's very rare that you can get that kind of a discounted buy with the rinse and repeat easy renovations to meet market rents, which are leading to $200 to $300. And One of the benefits of our business structure is that, we're filed as a 506c, which means I can kind of be forward facing. I can talk about our investments directly. And so that's one of those opportunities where, our investors can come in and all of a sudden on day one be diversified across 7 properties in 2 states in a portfolio, and we can immediately start distributing monthly right off the bat.
Yeah. Yeah. I like that. I like the model. And I think portfolios are definitely a great way to go as far as diversification goes. And you said $36 million raise. Is that what you said? $32 million raise. Okay.
We're only down to a couple million left, actually.
All right. And that's significant. I mean, that's more on one portfolio than, our company's raised on, a whole lot of units, so very, very substantial there. Anyway, so something you mentioned earlier, you talked about the rinse and repeat, which is, something that I think about a lot. You go in and you're basically doing the same thing you've done on other properties. Your first time in, it may be a new experience, but if you're able to systematize things and, figure out the renovations and how to operate the properties, bringing on the second, third, and fourth properties, or, however many you have, is just a rinse and repeat situation. So it's one thing that's very nice about the business. There's obviously differences between properties, and you learn something new with every one, but for the most part, you can come in and just rinse and repeat what you've done, down the road or in the next community down. So,
and it takes some discipline, right? Because I'm constantly bombarded with those shiny objects. Oh, go do this vacation rental thing, or here's this weird crypto variant, or this or that. But, once you've done a project and you've executed it and you've done it again and you've refined and you refined, I find that sticking to our guns, very narrow criteria, very risk averse, low leveraged, and not major conversions between large assets, keeping the upgrade per unit costs down.
Yep.
If you just stick to this rinse and repeat model, just keep after it. And there's always ways to get a higher return, but not necessarily that level of a risk adjusted return. In other words, I'm convinced that the tortoise will outpace the hare from all the shiny objects out there if we just keep with the tried and true process.
Yeah. Yeah. Funny you bring up that story. I've always wondered about that story. I mean, why couldn't the hare just keep on going? Why can't you be fast and steady? But it took me a long time to understand the thing. And I think you're right. Slow and steady is going to win the race. When you talk about risk adjustment, when I look at risk now, and a lot different than I looked at risk, 10 or 20 years ago, if somebody has executed the business model before, that brings the risk level down. Or it doesn't, I mean, you can have a good business plan, you can have a good market, you can have a good property, but if you've never executed, that's a higher risk level. And so something else that you bring to the table is you've done it before, a couple of times, several times. And so when you talk risk adjusted returns, there's not just the lower level of risk from the properties you guys pick in the business plan, but from the execution side as well.
Yeah, I think that the 100%, the sponsor risk is oftentimes not quite looked at as strong as the deal risk and market risk, right? And the cycle risk of where we're at. And I think that one other thing that's strong is individuals like ourselves that have been through a downturn before. We've seen what happens when the debt markets dry up and your loan gets bought and sold. And a lot of the times when I'm talking to somebody that hasn't, they can't understand the questions I'm asking because they haven't seen it and been through it. And, when we talk about risk adjusted, we're saying, well, 67% break even occupancy means that we're putting 60% down, not 15% down or 20% down, like you see. But that shell of, back to the tortoise, it's a heavier shell to carry, right? But it's a steady, tried and true. And with the market volatility of BNC class multifamily or our workforce housing multifamily, it's only dropped into the 80s on occupancy, even in the downturns we've seen. But our break-even occupancy is well below that. We're cash flowing on day one. We'll be able to ride it out, right? We got 6 months worth in operating reserve just earmarked in an account just in case. That means 6 months worth of expenses. We could float the entire property if we don't get income for 6 months. Tornado hits, we're first in line to repair and get back up and running because we already have the cash to do it. And then after the fact, we can go after our replacement costs, insurance, and our loss of revenue or rent insurance. And the interesting thing is, by the time you've done that, now you have new buildings, which they were old, and it's less cost to do the renovation of those buildings because you're renovating now building to the new renovation level. And they're insured for 100% occupancy. Well, they weren't 100% before, but as long as you have the cash on hand to float forward to recover from those, and you've not squeezed every last dime out of the deal, then it's a very low risk asset. It's well capitalized, it's low leveraged, and it can recover and withstand the test of a market cycle or a natural disaster. And I think, all of that, it may lower your return. We're not going to be having 20 plus IRRs in our deals, Brian, right? We're going to have risk adjusted returns, ones that are down because we've decreased the risk, right? But way better than stock market and way more tax advantaged and inflation hedged. And you're not going to lose it all one day because it's a hard asset, right?
So yeah, lots of goodness there. So last question for you, what's next for you?
Well, so our company has been kind of going through a little bit of a shift where I tend to be more of a head to the grindstone, get the work done engineering type. And I hadn't done any podcasts before the beginning of this year. I hadn't gotten out there really. And so now we're finally starting to get the message out. I mean, I have a high-tech career in automation and robotics, so it's fairly well known there. And many of those individuals have invested with me and have. And even the guy that originally got me on the real estate path like 20 years ago, he's still investing with me in my deals today. But now we're getting the message out there. We're doing a PBS educational piece. I've got, which I'd like to offer to your listeners. I did I contributed a chapter in a book co-authored it with some other people. It's called Persistence, Pivots, and Game Changers, Turning Challenges into Opportunities.
Nice.
I'm over here, much better looking guys or everywhere else, but I had hair back then. But there's Russell Gray from the Real Estate Guys, Phil Collins, lead guitarist at Def Leppard, entrepreneurs, NBA, NFL coaches and players. So there's a lot of really fun. This was a great project, tells my story, and I'd be happy to give it to a signed hard copy to your listeners if they want to go to our site and sign up for an investor strategy session. We talk about your goals, and I believe in this content, and I believe in what this story does. It's a lot of really cool people in here. I'd be happy to do that. So we did this, and we've got some information, passive investor guides out there. And I am starting a podcast myself, and starting to invest more I'm a Forbes author now, and I've got 2 articles they published, and I'm on a 3rd on the way. So I'm just trying to work on getting that message out there because financial education is very underserved in the country and generally globally. And all you learn to do is a savings account and a checking account, and then you trust in 401ks, and people don't even know that means you're just guaranteed to work forever. And diversifying your portfolio
until you're old enough to start pulling the money out, and who wants to do that, right?
Exactly. And then your basis dwindles until you pass, and that's not really legacy wealth in that case.
Yeah. All right. So for anybody listening, if you're interested in that, we'll have in the book offer, we'll have a link to the website where you can grab that. Encourage everybody to take them up on that. So we're going to shift gears and bring Sarah on. So I've already welcomed you, but guess what? I'm going to welcome you again. Welcome to the show.
Thank you. I'm excited to be here.
Awesome. So do us a favor and tell us a little bit about yourself.
Yeah, so I live in a small town in northeastern Iowa. Population's about 10,000 here.
Okay.
But I graduated from the University of Northern Iowa in 2020. I graduated with a degree in biology and a minor in chemistry. So right after college, I worked in a microbiology lab. I had the white coat, I was wearing the gloves and the goggles. It was really cool for the first 6 months. And then I realized there was no growth here. It was a 9-to-5 job working 40 hours a week. And I thought to myself, I don't want to be doing this for the rest of my life, you know, working for my money, trading my time for my money. And so about a year into that job, I decided to quit and reevaluate, think of new things I could do. And my boyfriend and partner, he's always been kind of an entrepreneur, and he's always had this kind of ear or this eye on real estate. And so I applied to be a property manager in my town with no experience. I had to go through 3 different interviews to prove that I could handle this job and this position. But I wanted to become a property manager so I could get hands-on experience on the operation sides of assets and learn how important it is for your on-site manager, because they can make or break the deal, make or break the cash flow.
Yeah.
And so it's been great. I've been doing that for about 6-7 months now, just getting my hands dirty. We are still hunting for our first deal. We do officially have an LLC up and running, First Ascent Equity, which was really exciting to go through that process.
Yeah.
And so we decided the real estate, to pursue the real estate avenue, because we both also work at a CrossFit gym in town. And one of the members there is a pretty big fish in the real estate investing industry. And so we've kind of been learning from him, and then going to meetups and hopping on calls like these with experienced investors to just try to better acknowledge and help us get that first deal, because after that first deal, they say it's easier. And so super excited to be here and to ask you some questions, Patrick.
Good for you, Sarah. That's a great story. I'm glad to see that trading your time for money thing that happened early on. That's awesome.
Yes.
I wish I would have realized that, earlier on as well. I mean, so I had 2 degrees in math, and quite frankly, I wanted to teach, and I was working towards math so I could be able to teach. And I realized, way too late after getting 2 degrees that, I was not passionate about math. But, you made that discovery a lot sooner, a lot earlier in life than I did, which is, good for you. And the other thing that I'd like to say is just, good for you for, going into a job where you can learn, and that's something that I wish I would have done or had the courage to do when I was a lot younger, is, go into a job so I can learn a business, learn an industry, so that, later on in life, I could capitalize on it. So, and you get in a job with the property management is going to, pay lots and lots of dividends, later on down the road. So,
I think the biggest thing I've learned from this job so far is that I don't want to be a property manager forever. I want to get to the point where I can pay someone to do this job.
Well, at least you're starting at one of the toughest jobs, right? Because that's why I got away from single family, because now I have on-site property management. They call me.
Yeah, absolutely. Well, let's talk about your big burning why. You talked a little bit about your motivations, but if you can distill it down to why you want to do this.
Yeah. And so, like a lot of people, I want the financial freedom where you don't have to worry about what you're doing is bringing in the income to support yourself and your family. And so I'm really young. I'm 24, so I don't have a lot of responsibilities right now. I don't have a family. I don't have kids. I don't have a house payment. So I realized right now is my opportunity to really roll up my sleeves, get my hands dirty, spend the next 3-5 years getting experience and getting those assets built up, so that I can eventually do stuff I'm really passionate about that I know won't bring me any money, and that I can still support a family and be there for my family when I do have one.
Yeah.
And so I've got these crazy passions and ideas. Like I want to be on Shark Week, and I would love to create content for Shark Week, but I can't rely on that to put food on the table for a family. And I'd love to somehow be part of Cirque du Soleil. I don't know if you've ever watched that cirque down in like Vegas.
Can you do a demonstration for us?
Oh, no, I not be in it, but be on the board or something.
Oh, got it. Okay.
That ship has failed.
Yeah. So there's somebody in this industry who runs a podcast that was actually part of Cirque du Soleil. Started out as a wrestler. He's Australian by trade. And for some reason I can picture his face, but I can't think of his name right now. But went from professional wrestling to Cirque du Soleil, and a lot of cool stuff there. But
maybe he'll do the demonstration.
Yeah, exactly.
Yeah, we'll let him do it. But anyway, lots of cool stuff there. But anyway, we're coming up to my favorite part on the show where I get to sit in the back seat for a second and listen to some magic happen. So Sarah, we got Patrick on the line. What do you want to ask him?
Yeah, so Patrick, my first question for you is, what obstacles or oppositions did you face when acquiring your first deal, and how did you overcome them?
Yeah, well, that is, there's a lot, right? And quite honestly, there's a huge dropout rate in the space from, people that kind of say, hey, I'm going to go do it, to people that actually make it happen. It's a combination of oftentimes a career change and being an entrepreneur. And it really takes these two kind of things because in the space, when I got into it, I didn't know anybody that was in multifamily, and I wasn't certain that the first multifamily was it. I just knew single family wasn't it. I needed to find something else, and I heard all kinds of different strategies, and nobody was shining a light saying walk towards it. I picked up some books that were lamps, and they led me in different paths, and I kind of finally started finding a strategy which made sense. And I think when I kind of went through that process, I was doing courses, I was going to seminars, and I was taking notes, and we were getting nights and weekends at Starbucks and I invited my wife too. And she went through the videos, didn't quite take the notes I did. I'm that guy that will work full time and go do 2 master's degrees, right? A little bit of a glutton for punishment like Brian.
Yeah.
But but this was kind of my third one, right? And I kind of treated it that way. So, when you just start, I joined some of where I originally met Brian was through a Slack channel where, I was finally getting deal flow or just going online, finally meeting brokers, and I was submitting offers and uploading, underwriting, getting feedback, and just kind of grinding it out. And there was an old boys club where I would literally go meet with a broker in Tucson, for example, for like the 5th time, and then find out he just awarded a pocket deal to another syndicator, Bakerson. And then, I'm like, well, he's worked with them like 10 years. So I can't blame him, but how do you break into that, right? And, so part of what I did was I partnered up. I started talking to people like Brian. In fact, his team, we actually got real close to working on a deal together, which they're now exiting, which is great. I'm really excited to hear that from them. So kudos, Brian, on that. I didn't participate in that. I went some other directions and other kind of assets in other markets, actually. And but you got to kind of find that path. And ultimately, Brian and I took similar paths. We partnered up with different people where we each had our superpowers, and each person kind of fell into a niche where you could be excited. And you keep bringing deals, you keep showing up. I think a lot of the times people would try and push value on me. I get all the time like, here's the deal, here's the deal. I'm like, well, that's not what I'm looking for. They're not inquiring, what do you actually need right now, right? What will advance me? What help do I need? And rather than I need, and I think that that's probably the obstacle that I found was finally finding or opening up my ears. They say, when the student's ready, the teacher will appear. When I opened up my ears and I found what partners were, what value I could match, then all of a sudden it was obvious. And I did the first deal. And then immediately we started the second deal without even a blink. And then the third deal was almost in parallel with the second deal. And that law of the first deal has happened when all the cards finally line up and you met the right people. But that happens through the trenches of just getting after it. For a lot, I mean, it's traveling all over, meeting all kinds of people. A lot of things didn't go right. I lost money during this time, walking away from deals and traveling and investing in things that I was like, no, this isn't right. This isn't right. This isn't right. Yeah. But each time I said no, it drew me closer to the right people. It attracted the right people. It solidified in my mind what I wanted to do. And I gained experience along the way.
Yeah. I would add to that, there's a reason why I ask everybody their big burning why on this podcast, because I had a big burning why, and it was, bright and burning and red hot. But there were a lot of times where I wanted to give up. I wanted to quit. And it was that big burning why, I just would remind myself of that every time, hey, this is why I'm doing it. And, Patrick he said trenches, it's hard. It's not an easy thing to get into. And there's lots of stumbling and lots of failures on the way and a lot of near misses and a lot of A lot of things you have to push through, so when we talk about challenges, everybody has different challenges, but everybody has challenges. So, how did I get through is I had a really clear why, a really clear reason for wanting to do it. And every time things got tough, I just reminded myself of that why and pushed.
I knew that the military verbiage there would ring true with Brian.
Yep.
It was Winston Churchill that said, if you ever find yourself traveling through hell, keep going. Right?
Keep going.
Don't stay there.
Yeah.
Don't give up. Just
Hell's the last place you want to stop.
Yeah, exactly.
So, yeah, keep going.
Awesome. And so did you have like a moment when you had a mindset shift, or like how did you have to change that mindset in order to keep moving forward and keep going through those trenches?
Ultimately, how I got into the business was I brought dozens of deals to specific individuals that shifted over time until I finally found a few. And then one of the guys said, hey, let's work together. And the mind shift, I think, was in the heart of what I was saying. And that's getting into the first deal. That's right. The mind shift for me was first high risk land, getting away from speculation, getting to calculated investments in single family, and then scaling to multifamily. But to get the first deal, the mind shift was, what does he need from me? Mm-hmm. Listen and probe into that, and then do it all. Recorded the Zoom call of everything he had going on, and I did everything I could. And ever since, I've done every deck for every deal I've done. I've been flying out, doing the due diligence, getting grimy and dirty, or inviting investors out, literally going through the mud and the down units and the mold, and getting the dirt, sifting through it all and reporting. And I think what I found out was, well, this guy didn't need a deal. He's got deal flow. This guy didn't need capital. He's got all the capital he needs, but he's busy, right? And he needs key players that are willing to get the work done, are willing to. And I didn't even know what percentage I was going to get out of my first deal until after we closed. And that also was with the second deal. I had just had to trust that I believed in the deal. I knew what was happening. I understood it inside and out, and I was all in. Finally found a partner that had the same risk-averse approach, conservative underwriting, low leverage, long-term fixed interest, all the things that I knew would survive a downturn. And it was the right path for me. I invested in those deals. And at the end of the day, it developed great partnerships moving forward, right? And I think that was probably, that helps to answer a little bit.
Yeah, it does. And it actually started to answer my next question that I have for you. How do you make yourself stand out from everyone else who wants that same opportunity that you do?
Well, what I think, showing up consistently to the plate, even if it's them telling you with your ducks in a row, this is the work I've done. This is what I've got. Is this of value to you? Here's a deal. Here's my concerns. Here's why I think it's good. They come back. Well, here's what you shouldn't be concerned about. Here's what you should be concerned about. They didn't even think about, right? And then adjust your process and move forward. And I think learning, pay attention, and continuing to show up, you're going to stand out, because there's a lot of noise out there about this being a get rich quick scheme. It's like 2.5 years from the day I said I'm not going to do single family to the day I actually closed on my first multifamily deal.
It's not get rich quick.
It's not. Yeah.
Yeah. It's get rich slow is how I call it. Yeah.
Yeah. But it's true. It's a steady, tried and true process, but you got to keep getting after it. And I think if you show up in that way where, they're so worried about getting rich on a first deal, and they're so worried about the return, and they're not leading with value. They're not leading with, showing up as somebody who's going to make their lives easier, give them back their nights with their family, and let them go on vacation, and be kind of outwardly focused, right? Not only for your partners, the sponsor you're working with, as well as your investors, right? Then that they're going to see right through that.
Yeah. There's something he said that I'm a firm believer in, is just showing up. If you just show up every time, you're going to set yourself apart from everybody else. All right. Of course, there's the next level of, you've got to show up and then do the right thing, but just showing up and consistently showing up at the right place and the right time is going to put you ahead of a lot of people. And then the one thing I'll add, this podcast, for example, is something that I've done to try to set myself apart. Everybody does it differently. Everybody has their own individuality that comes to play in it. But, for me, setting myself apart, part of it's the podcast, part of it's our educational community that we've created. A lot of what I've done has been on LinkedIn, and just, posting some very personal lessons learned on LinkedIn. But, end of the day, showing up, figuring out what you can do and what your superpowers are, and, consistently showing up and consistently delivering. Slow and steady.
Awesome. Yeah. So my last question is more of asking for some advice. So I'm young, I work a couple part-time jobs, and I'm deciding whether or not I should get a full-time W-2, build up some capital, and do real estate investing on the side, to get more experience, get the first deal, but still building up the capital with a full-time 5 to 9 job, or if I should really dedicate myself right now to learning, really networking, getting part of teams, and dedicating it full-time while having some part-time gig on the side, and really immersifying myself in this field while I'm young and I don't have a lot of bills to pay and a lot of responsibility. And so just asking for any advice, suggestions, or experience you may have with this, for someone who's young, just getting into the field.
Oh, right. That's for me. Forgot. Yeah.
Yeah. You're first.
Yeah. Well, so I don't know your specific situation, Sarah. Everybody's got their financial needs. And anytime you jump out into an entrepreneurial venture, or even if you talk to a financial planner, which I'm not a big fan of, you might agree on one thing, and that's that you do need some reserves, right? You need emergency reserves, so like 6 months to 9 months of reserves. And so and then Robert Kiyosaki talks, to be financially free, you got to either decrease your expenses or increase your passive income. So what I like to say is, if you can live conservatively and in a way where you have the ability to go to college, right? Or go to a master's degree, or what I like in my mind, if you start a venture, you need a runway, right? Any entrepreneur needs their runway. I think it's great to go all in somewhere. Mm-hmm. And I think that if you have the means and the ability to just go completely all in and show up at any time of day, because when I need it, when I get a phone call saying, hey, we have your deal, it's in Dallas, we can't tell anybody about it, can you get out there? I red-eyed from Oahu and landed in Dallas that night, that morning. I showed up at the property that next day, and we spent the next 3 days walking units, mm-hmm. right? And then we spent the next 3 days getting the CapEx budgets and getting this underwritten so that we could decide whether or not we wanted to put the earnest money down and proceed. That was a real need. And so that flexibility, that all in, that reliability, if you have the means to go full-time, I'd say go full-time. You offer a whole different level to a sponsor. Or if you have some flexibility, like if you're going to take on a job, maybe craft it around something that allows you to be available when brokers are there, right? When you need to talk to lenders or insurance agents, or the only times a day that you're going to get access to these apartment units to do due diligence walks is typically either weekdays or sometimes weekends, but weekdays, between 8 and 5, 8 and 6, right? Mm-hmm. So if your full-time job prevents you from doing any of that, it certainly reduces mm-hmm. the amount of value that you can put. So, technically I'm a contractor, right? And on the other side, doing machine design, automation, and robotics, and still to this day. And during COVID, when multifamily dried up, it allowed me to dive in there. I didn't get a single order in Q2 from engineering, but I pivoted to COVID automated in 2020. But I pivoted to COVID automated assembly test kits. And then I had 2 record years, right? Producing automated machinery for test kits. But multifamily completely dried up. There was nothing going on. Nobody could get a loan. Everything was frozen, right? So some flexibility in another high income producing way, or something that maybe if it's not high income producing, but something that'll keep you going, right? To meet your needs. There's some value to that.
Yeah, I'm also going to borrow from Robert Kiyosaki, and it goes right along with what Patrick said. But if you read Rich Dad Poor Dad, he says that Robert and his wife Kim, at one point were homeless, living out of a car while they were building their business. Now, do you have to go that far? No, but they put all their time, effort, and energy into building something, and ended up, building something that has affected a lot of people. But, basically you got to go all in. The longer of a runway you have, the better off you're going to be. And I had a job, I was active duty military, and I knew what my first eligibility for retirement would be. I gave myself a 3-year runway, and I had the job Patrick said don't have, the one that's not very flexible, the one where you're, inside a box from 9 to 5 and you can't talk with the outside world. But
you were trapped in the Pentagon during COVID.
I was
right?
trapped in the Pentagon.
Yeah.
And some days I felt like I was trapped, but
yeah.
You can walk out at any time. But yeah, end of the day, I just had to keep on pushing through. I had to be all in, and I had to make sure that I could still deliver. I could still show up, but, go all in, whatever that means for you. If you have that runway, like I said, I had 3 years of an active duty paycheck that kept on coming in regardless. And that was my runway, and, saved up every penny that I could. And, now I'm in charge. Yeah. Now I'm flexible. Now I can
he's
do
a
whatever
rock
I want.
star.
Yeah. So
Beautifully put, Brian.
yeah. So anyway, well, thanks a lot to both of you for coming on the show today. We do have to wrap things up. And incidentally, the reason we have to wrap things up is because her business partner, Kyle, is recording with me in about 6 minutes. So one final question for both of you. Patrick, you get to go first. How can listeners learn more about you?
Yeah, sure. So investonmainstreet.com, all spelled out, investonmain and then street.com is our website. We have a bunch of great content there, as well as information about our current investments. In addition to that, if you want to set up an investor strategy call, we'll ship you a signed hard copy of this book, Persistence, Pivots, and Game Changers. Or you can shoot me an email at patrick@investonmainstreet.com, and I'll be happy to set up a call and chat with you about your goals and see if I can get you in the right direction.
All right. Sounds good. And we'll have links to the website and your email address in the show notes for anybody interested. Sarah, same question for you. How can listeners learn more about you?
Yeah, so you can find me on LinkedIn, Sarah Hannah, H on the end of Sarah, no H on the end of Hannah.
Mm-hmm.
And you can email me at sarah@firstascentequity.com. And those would probably be the best ways to get a hold of me.
All right. Sounds good. And that information will go into the show notes as well for anybody interested. And once again, thank you so much to both of you for your time today. And that's a wrap.
Thanks, Brian. And good luck to you, Sarah. Happy to get to meet you.
Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.